Why does investing drain mental energy? A behavioral and neuroscience perspective. Investing is often described as passive, but psychologically, it can be deeply exhausting. Even when you're not trading, thinking about money, risk, and uncertainty consumes cognitive resources. Here's why. 1. Uncertainty is mentally expensive. The human brain evolved to reduce uncertainty. Research from University College London shows that uncertainty activates stress-related brain regions more strongly than known negative outcomes. When you invest, you constantly face unknown outcomes, probabilistic returns, uncontrollable variables. The brain interprets uncertainty as potential threat. Maintaining vigilance over uncertain outcomes consumes mental bandwidth. 2. Continuous risk evaluation. Behavioral research by Daniel Kahneman suggests that decision-making under risk requires cognitive effort. Even passive investors mentally simulate. What if the market crashes? Should I rebalance? Is my allocation correct? This constant background simulation consumes working memory. The brain keeps running scenarios, even when you're not actively trading. 3. Ego depletion and decision fatigue. Psychologist Roy Baumeister introduced the concept of decision fatigue. Every financial decision, even small ones, draws from limited cognitive resources. Examples: choosing allocation, deciding whether to check prices, interpreting news. Over time, repeated micro-decisions reduce self-control capacity. Investing becomes draining not because it's complex, but because it's continuous. 4. Loss aversion is emotionally costly. Loss aversion, introduced by Amos Tversky and Daniel Kahneman, shows that losses feel roughly twice as painful as gains feel good. Even small portfolio declines trigger emotional discomfort, rumination, stress. Frequent exposure to fluctuations amplifies this effect. Emotional processing consumes energy. 5. Attention fragmentation. Modern investors are exposed to notifications, market headlines, social media analysis. Each exposure interrupts focus. Cognitive psychology shows that task switching reduces deep work capacity and increases fatigue. Checking markets fragments attention, even if only for seconds. 6. The illusion of control loop. Investing creates a subtle illusion. If I monitor closely, I can manage outcomes. But most market movements are uncontrollable. This mismatch between effort and control creates cognitive dissonance. The brain expends energy trying to optimize something partially random. 7. Emotional regulation costs energy. Long-term investing requires patience, emotional suppression, resisting impulses. Self-regulation is metabolically costly. The prefrontal cortex, responsible for restraint, consumes energy when inhibiting emotional reactions. Repeated restraint leads to fatigue. Why passive investing feels active. Even if you don't trade, you think about outcomes. You imagine scenarios. You monitor progress. You regulate fear and excitement. That invisible cognitive effort accumulates. Investing drains energy because it combines uncertainty, risk, emotion, identity, future-oriented thinking, all at once. Practical implications. To reduce mental drain, automate contributions and rebalancing. Limit portfolio checks to scheduled intervals. Write a clear investment policy statement. Reduce financial media exposure. Shift focus from short-term price to long-term process. Energy preserved is discipline preserved. Core insight. Investing doesn't just test capital. It tests attention, emotional stability, and cognitive endurance. The investor who conserves mental energy often preserves long-term return.